Everyone wants to go to America. It's the biggest market, the biggest opportunity, the biggest prize. And for most brands, expanding internationally is the wrong place to start. Because the size of a market and the readiness of your brand for that market are two completely different things. And confusing them is one of the most expensive mistakes in global expansion. So in this video, I'm going to show you how to actually pick your first international market. Not based on where you want to go, based on where you're most likely to win. A few years ago, a founder came to us with a strong premium skincare brand. UK based, doing well, real loyal customers, genuinely differentiated product. And their plan was simple: go to the US. They spent months preparing for it. US website, US adapted packaging, PR agency in New York already lined up. I asked them one question: why the US? They looked at us like it was obvious. Because the biggest market. That's when we knew we needed to have a different conversation. Here's the thing about large markets that nobody says out loud. Size creates competition. The US is the most attractive market for consumer brands in the world, which means it's also the most crowded, the most expensive to acquire customers is, and the most demanding in terms of brand credibility you need to earn attention. If you're a UK brand with a strong home following, but limited international proof points, walking into the US market is like turning up to a fight you haven't trained for against opponents who've been there for years. Your customer acquisition costs will be high. Your brand recognition will be zero. Your logistics costs will be significant, and your margins will be under pressure before you've made a single sale. None of that means you can't win in America. Plenty of brands do. But the question isn't whether you'll get there eventually. The question is it the right first move? And for most brands, it just isn't. When we work with brands on market selection, we look at three distinct types. Each has a different risk profile, a different opportunity that suits a different stage of brand development. Number one, the adjacent market. These are markets that are actually culturally and commercially close to where you already operate. For a UK brand, this typically could be Ireland, the Netherlands, Germany. Language is either shared or high proficiency. Consumer psychology is similar. Your existing creative often translate with minimal adaptation. Logistics are manageable. Regulations, while different, are navigable. These markets won't make you a global brand overnight, but they're where you prove the playbook works internationally. You learn without paying the full price of the education. Type 2, the high growth market. These are markets where consumer demand is rising faster than supply. The Middle East, particularly the UAE and Saudi. These are a strong example of this right now for premium consumer brands. Rapidly growing middle class and high average order values. Strong appetite for international brands that carry status and quality signals. The opportunity is real, but so are the requirements. Distribution infrastructure matters here. Local partnerships often matter, and brand presentation needs to feel elevated. This is not a market that responds to discount-led positioning. Type 3, the scale market. This is where the US and core Western Europe sit. Germany, France, the US and Japan. These are the markets that transform businesses, but they require a brand that's already proven internationally. Because the competition is intense and the cost of failure can be high. These are markets you earn the right to enter, not markets you start with. So how do you make the decision? We use 5 filters. Run every potential market through all 5 before committing. So filter 1, organic demand signals. Before you spend £1, dollar or euro, entering a market, look at where you've already seen interest. Website traffic by country, social followers by geography, existing international audience. Where are people finding you without you trying? That's where real demand already exists. That's where people are already finding you. Filter 2, friction to enter. Some markets are straightforward. Others require regulatory approval, local partnerships, product reformulation, or complex legal structures. Map the friction before you map the opportunity. A slightly smaller market with low friction will often outperform a larger market with high friction, especially as a first move. Filter 3, unit economics in market. Model the real margins after duties, local fulfillment, costs, platform fees, and currency. If the numbers don't work at current volume, understand exactly what volume you'd need to make them work, and whether that's a realistic thing for you in year 1. Filter 4, competitive landscape. Who's already winning in this category in the market? Are they dominant, or is there genuine room? A crowded market with entrenched competitors requires significantly more investment to crack than one where the category is developing. Filter 5, brand fit. This is the most underrated filter. Does your brand, your positioning, your aesthetic, your price point, your values resonate with the cultural context of this market? Premium British heritage plays very differently in Japan than it does in Germany. Health-led messaging lands differently in the US than in France. Don't assume fit exists. Test it. Back to the founder with the skincare brand. When we ran their brand through those 5 filters against the US, the picture was clear. Organic signals from the US were moderate. Strong signals from Australia and the UAE were being ignored. Friction to enter the US was high. FDA compliance for certain product claims, high logistic costs, a market requiring significant PR investment to build credibility. Unit economics in the US were marginal at current volume. Competitive landscape was brutal. The premium skincare category in the US is dominated by brands with decades of presence and significant marketing budgets. But Australia, low friction, English language, strong organic interest already showing in their analytics. A premium skincare market that was less saturated. Logistics from the UK were workable, just. And the UAE, a high growth premium market with strong appetite for British beauty brands. Lower competition in their specific niche and higher average order values that protected margin. We recommended starting with Australia. Within 6 months, add UAE. Hold the US for 18 months until they had international proof points, case studies, and a brand story that could compete. They weren't happy about it at first. America felt like the goal. But 18 months later, they built profitable operations in 2 markets, had genuine international credibility, and entered the US with a track record. They won in America, but they won it properly, by earning it. I want to spend a moment on the Middle East specifically, because it's the most underestimated market in international expansion right now for consumer brands. The UAE in particular has some of the highest per capita consumer spending in the world. The population is young, digitally engaged, and highly brand conscious. There's strong cultural appetite for international brands, particularly those with credible heritage, quality signals, and premium positioning. What makes it particularly interesting is the combination of high demand and relatively low digital competition in many of the categories. While UK and US brands are fighting each other ferociously for market share at home, many of those same categories are wide open in the Gulf. The requirements to succeed there are real. Brand presentation matters enormously. Logistics and fulfillment need to be solid. Local market understanding, whether through a partner or through research, is important. But for brands with the right positioning and the right product, the return on investment for entering the Middle East can outperform more obvious markets significantly. It doesn't get talked about in a standard expansion conversation, but it should. So here's the framework in one sentence. Start where you're most likely to win, scale to where the prize is biggest. Those are usually different places, and confusing them, going for the prize before you've built the proof, is where most brands lose time, money, and momentum. They typically pick the market where the signals already exist, the friction is manageable, and the economics work. Win it cleanly, then use that foundation to earn the bigger markets. That's how you build a global brand, not by chasing the biggest flag, by planting the right ones in the right order. In the next video, we're going to talk about something that's equally important and equally misunderstood. Once you've picked your market, how do you actually reach customers in it? Amazon, D2C, wholesale, retail, digital first, distribution led? The channel decision shapes your margins, your brand, and your growth trajectory for years. And most brands get it completely backwards. That's next.